Question 1. Explain leverages. Answer. Leverage is a general term which is used in financial management, and it is used as a technique to multiply the gains and losses. It refers to attainment of more benefits on comparative lower level of investment or lower sales. There are many ways to attain leverage. The most common of them all is borrowing money, buying the fixed assets, and use of derivatives. Examples of these are as follows. Public corporation may leverage its equity by borrowing money. The more a company borrows, less equity capital it needs, so the profits and losses are shared among a small group of people. Business corporation may leverage its revenue by buying fixed assets. This will get more fixed proportion to the company rather than variable cost, as change in revenue will result in larger change in operating income. Question 2. What are the different types of leverages computed for financial analysis? Answer. Different types of leverage computed for financial analysis, and they are as follows. Operating leverage. It is a leverage which refers to the enhancement of profits because there is a fixed operating cost which is involved with each and every component. When the sales increases, fixed cost doesn't increase and it results in higher profit. Higher fixed expenses results in higher operating leverage, which leads to higher business risk. Financial leverage. It is a leverage which refers to high level of profitability because of high fixed financial expenses. It includes interest on loan and preference dividend. Higher financial leverage indicates higher financial risk as well as higher break points. In this kind, the managers have flexibility in choice of capital structure. Combined leverage. It is a leverage which refers to high profits due to fixed costs. It includes fixed operating expenses with fixed financial expenses. It indicates leverage benefits and risks which are in fixed quantity. Competitive firms choose high level of degree of combined leverage, whereas cooperative firms choose lower level of degree of combined leverage. Question 3. What is combined leverage? How is it calculated? Answer. Combined leverage is a leverage which refers to high profits due to fixed costs. It includes fixed operating expenses with fixed financial expenses. It indicates leverage benefits and risks which are in fixed quantity. Competitive firms choose high level of degree of combined leverage, whereas conservative firms choose lower level of degree of combined leverage. Degree of combined leverage indicates benefits and risks involved in this particular leverage. Question 4. Explain net income approach. Who proposed this theory? Answer. Net income (NI) approach, as this is also called as traditional approach. This is an approach in which both cost of debt and equity are independent of capital structure. The components which are involved in it are constant and doesn't depend on how much debt the firm is using. This theory was proposed by David Durand. In this, change in financial leverage leads to change in overall cost of capital as well as total value of firm. If financial leverage increases, weighted average cost decreases and value of firm and market price of equity increases. If this decreases, then weighted average cost of capital increases and value of firm and market price of equity decreases. The assumptions which can be made according to this approach is that there are no taxes involved in this, and the use of debt doesn't change the risk factor for the investors and will remain the same throughout. Question 5. What is capital structure? What are the principles of capital structure management? Answer. Capital structure is a term which is referred to be the mix of sources from which the long-term funds are required for business purposes which are raised to improve the capital of the company. To fund an organization plan, this capital structure is required, which is the combination of debt and equity. The management ensures the capital structure accesses which are needed to fund future growth and enhance financial performance. The principles of capital structure management which are essentially required are as follows: cost principle, risk principle, control principle, flexibility principle, timing principle. Question 6. Explain traditional approach of capital structure. Answer. Traditional approach is also known as net income approach, but it is the simplest form. It is in between the other two theories named as net income theory and net operating income theory. This approach has been formulated by Ita Solomon and Fred Weston. This theory gives the right uncorrect combination of debt and equity shares and always lead to enhanced market value of the firm. This approach tells about the financial risk which will be undertaken by the equity shareholders. This approach focuses mainly on increasing the cost of equity capital, which will be done after a level of debt in the capital structure. Question 7. Explain operating income approach. Who proposed this theory? Answer. Operating income approach is the approach which suggests the decision of capital structure towards a firm is irrelevant and change in leverage or debt doesn't result in change of total and market price of the firm. It tells that overall cost of capital is independent of degree of leverage. This approach was also proposed by David Durand. Question 8. Explain low operating leverage, high financial leverage. Answer. If financial leverage is high, then the funds are obtained mainly through preference shares, debentures and debts. This makes the base solid by keeping the operating leverage low on scale. The financial decision can be maximized as the management's concern can be earning per share, which will favor the debt capital only. This will increase when the rate of interest on debentures is lower than rate of return in business. The decision is based on earning per share without any indication of the risks involved. Question 9. Explain low operating leverage, low financial leverage. Answer. This is also a worst situation where both operating leverage and financial leverage are low, which results in undesirable consequences. Low degree of these leverages shows that the amount of fixed costs is very small and proportion of debts in capital is also low. The management in this situation might lose number of profitable opportunities and investments. Question 10. Explain high operating leverage, low financial leverage. Answer. High operating leverage indicates that company is making few sales but with high margins. This shows the risk if a firm incorrectly forecasts future sales. If the future sales have been manipulative forecasted, then it creates a difference between actual and budgeted cash flow, which affects the company's future operating ability. Low financial leverage indicates that management has adopted a very good approach towards the debt capital. This decreases the management decision making on earning per share. This is the optimum situation.